Hi, everyone, and welcome to this week's In the Know Trader Show. I'm Rick Bensignor, and today is Tuesday, October 29th, and lots going on in the markets. S&P's up on all-time highs. We've got the Dow kind of flat today and the NASDAQ down, but of course, the news that the media is going to be all over, starting with yesterday, is the push to new highs in the S&P 500. So we're going to focus on that today and kind of make the show about that because it's important in multiple ways. So looking at today's agenda, we'll take a look at the macro sector relative movement like we do each week. We'll take a look at the S&P itself, and then we will spend the bulk of the rest of the half hour we have together looking at each one of the 11 macro sectors that make up the market, using their main ETFs, the SPDR ETFs. And this way we'll get a good sense of kind of what's going on underneath the surface, which ones are actually up on all-time highs and which ones are lagging and potentially still well beneath their 2018 highs. So let's start off with how to get in touch with me. It's rick@inthenowtrader.com. Thank you for the continued emails that we get each week after doing this show. And then, of course, check out our website, inthenowtrader.com, for lots of videos on tutorials, public appearances I have, whether they're TV or conferences, real vision interviews, etc., and more information about how to subscribe. So let's start off with comparing where the 11 macro sectors are on a year-to-date basis over the last 5 days of trading since last week's show, and then compare it to where it was 2 weeks ago so we can see kind of what's moved in the last week. So on the right-hand side is the most current through yesterday's close. Again, these are all relative to the S&P's performance over the year, so these are not net changes on the year, but how much each one of the sectors have outperformed or underperformed the market. And the ones with the dots underneath them are the ones that have changed at least 1% from the prior week. So let's start off on the left-hand side of the right-hand chart. Consumer discretionary, it's got a red dot, so it means it fell at least 1% over the past week, and we can see that it materially moved, actually a couple percent in the last week with some underperformance. Let's go into the middle there in kind of purple. Staples had been up over 2%. They're now up only 1.12%, so a decline of over 1% in relative terms to the S&P. And on the far right-hand side, we're showing a significant decline in the real estate side from over 12% a week ago to 7% and change this week. So real estate names getting hit hard. What's got some green dots? Well, we've only got one this week, and that is technology, which is gained the most. And in fact, it's the only one that moved over 1% in relative terms in the week. And it's up now almost 16%, outperforming the S&P versus last week where it was only 13.3. So we're getting big cap tech pushing this market higher. It's had a very good week, and we'll dig a little more deeply into things. So let's now switch to charts and take a look at the S&P and what we see. And this is a daily chart, and we're going to look over, let's say, the last 6-7 months or so. It's just obviously you can see on the far right-hand side, this is live as we do things. The S&P's at 3,044. So today, again, we took out yesterday's high, another new all-time high. But of course, what we have told you about and continue to be somewhat concerned about are the 13s that have shown up. And again, this is the sequential model. This is a model developed by Tom DeMark. And when we get these signals, it tends to indicate exhaustion of trend. When the numbers come on top of the price bars, it would indicate exhaustion of uptrend, or at the very least, a time that buying within an uptrend has inordinate risk. And that's the way we've posed this to our clients, is that we don't think that the market can't go higher. Actually do. The difference between being bullish and keeping what we have long as compared to being bullish and adding to the longs. And that's the difference here. So we are not currently adding to longs. We're content with the longs that we have. But anything that's breaking out on new 2019 highs, we're actually not buying right now. I don't mind buying some things that have been beaten up. So if you're interested in the energy sector or healthcare, some things that you have reason to think can go higher, those names I don't mind buying. But things that are on new highs, I'm less inclined to buy right now, simply because the risk is very high. And what do I mean by the risk being high? Well, let's say you bought something right now, even if it's, let's put it in the whole market instead of an individual name. You buy the S&P right here at 3,044. Where do you stop yourself out? At what point would, if you put new cash to work right now, where would you be wrong looking at it from the charts? And if the answer that you come up with is underneath the summer lows in August, when we had kind of that triple bottom down near 28.25, you're talking about risking over 200 S&P points before you first say, I guess having bought now is not right. Now, if you come up with something well tighter than that, that's good. But the theory would be that you'd want to make sure that the place that you're stopping yourself out is actually a place that would indicate that if breached, the market would go lower. Otherwise, you might potentially be stopping yourself out just as the market finds support again. So we're looking at this as a zone that incorporates anywhere north of 3,000 up to 3,064. And I'll show you why 3,064 is kind of the top end of the area I'm thinking about. And what it has to do with here, I'm going to blow this up. And let's get rid of these circles from the daily chart because they're not relevant. But you can see, obviously, the upside exhaustion signal of the 13 that came in July, saying exhaustion of trend. And that happened to come coincidentally just about exactly the same level as where the propulsion exhaustion level was. So that's why we had gotten negative at the time there and said we were going to get down to 29.11 to 28.88 or so. And we got down to 28.25, if I remember. 28.22 is the actual low, but now we've turned around. We need to properly hurdle, you see this level right here, 3,064, this dotted pink line. That's the level at which this 13 signal would get stopped out at. In other words, it would say that you no longer need to be concerned about exhaustion of the trend if we can get above that level. But it's not just getting above it on an outright basis. You have to get above it properly in what we call a qualified and confirmed signal. Therefore, we're in this, what I call 2% dead zone between 3,000 and 3,064. We're quite long. We actually don't have any equity shorts on right now, and we're making money as the market goes higher. We're just simply not adding here and now to the up move. Possible upside targets, well, in a big picture, if we can break out through 3,064, ultimately over time, this could be well into next year, you've got to target up at 33.36. Before you get there, I've got some other targets which are 31.20 to 31.36, and I think the other one was 32.23. Those are the other upside targets I have. But again, we're cautious here, and don't misinterpret that as being Rick's bearish. I am not bearish at all. I'm simply unwilling to put new capital to work on this move to new highs until it breaks above 3,064 and does so in a way that makes me think that we've really hurdled this area and that there's enough strength to push for the whole leg higher. Otherwise, again, it's very, very difficult to manage risk in this zone that we're in right now. So that's my take on the market. And also, while I'm talking about it, realize that if I were to switch to, just bring in a little more data here. So let's look at MDY, which is the S&P Mid Cap Index, right? And we go back to last year. And in fact, let's make this a weekly chart. It'll be easy to show. So we're still well beneath the highs, which were put in September of last year. Notice also on a setup 9 count, which often, along with 13s, can call for some turns. So mid-cap is not broken out to new highs. IJR is the small cap, the S&P small cap index. And similarly, this peaked in August, last week of August, last summer. And you can see it's well off its highs, and next week could easily get a 13 signal, which would also indicate potentially exhaustion of trend. And if that got accompanied, let's see, let's kind of throw a line up here across all these highs. So whether it's that high here or the high that was, we're running into resistance. So could this push higher? Absolutely. But it's going to be accompanied most likely with an upside exhaustion signal next week, which means what this all comes down to is a large cap rally. This is an S&P 500 rally. It is not small cap. It is not mid cap. Those are rallying, but they're not near their highs. So this is a rather defensive type rally in the scheme of things. It's money managers putting money to work in the largest, safest part of the market, which is the S&P 500, shying away more from the more speculative mid and small cap region. And again, even though we're seeing them move higher, they're not anything close to highs. So even though I think the market can go higher in general, realize that it's still skewed towards the big cap names, which implies that portfolio managers, although potentially putting some money to work, also are not as confident in the market and probably the outlook for 2020 because they're doing so in the large cap space. So that's just kind of an aside. Let's take a look at we're going to get through the 11 sectors of the S&P. We're going to do these on an outright basis, not a relative basis. So we're just going to look at the 11 charts that make up the 11 spiders and kind of see what they say. And we should be able to discern some difference between the 11 sectors and kind of where are better places to be and which ones are kind of weaker. So let's start off with, we'll do it alphabetically. XLB is the material space. You can see this week, first of all, it had an aggressive sequential upside exhaustion signal just before the decline. Like the S&P 500 itself, it never properly broke underneath the propulsion level. This held against it, it's turned back. Next week, we're already on an 11 count, so within 2 weeks, we can be up against a 13. Look for just shy of 61 is resistance, so you've got to get kind of a real breakout above. I'd almost use these levels in here and say you've got to take out on some multiple Friday closes 61.74 in order to think that this really can challenge and potentially take out that 2018 high. If it does, bigger, longer-term upside target is 74.93. Again, watch out for closes underneath 55.25 on a Friday basis. That opens the door for a test down towards this longer-term uptrend line. XLC Communications obviously has far less information because it's a new sector that was made up by S&P last year, so we don't have nearly as much data to work with. Nonetheless, you can see the 13s that were virtually side by side in this area here. We got the pullback. We've stalled now against 50.95. That's the propulsion momentum level on the upside. You've got to properly break through this level to then target 54.25 or so. It's going to be important how this closes this week relative to last week. If by Friday's close of this week, we close lower than last Friday's close of 50.32, and then next week rally and close above 50.95, then you have a much better chance of a clean breakout to the upside. Otherwise, you're still within the context here of an area that's going to pose some resistance. What do we got next? XLE is energy, the worst sector of the year. So let's take a look. In 2015, this made, or 14, all right? So it's 5 years ago since energy made its all-time high. And you can see we're actually much closer towards the lower part of the range than the higher end of the range. Let's also take a look at some of these 13 counts for if they've been good indicators of potential turns. So there's one here a little early before the bottom, but only a few weeks before. There's a 13 up here. Again, this came above price action, so it's looking for upside exhaustion. Actually nailed the exact top. There's a 13 in here and a 13 here, right near the bottoms. And then this is the one that we've played for in the no trader clients, was the 13 signal and the bounce off of that. So that's when we started looking to get long energy. And so we had an up move, a pullback, but it's moving up again. And that's actually somewhat positive. So even though this sector is not near as bullish as other people would say, because it's not near all-time highs and breaking out, a lot of people want to buy these breakouts. I'm actually more inclined to look at this type sector that's been beaten down. In fact, I'll tell you that in relative terms to the S&P 500, this sector made 19-year lows this year. In fact, here, I'll show you this chart. XLE divided by SPY, right? So this is, and let's do this on a monthly basis, and less concerned about these signals and just want to show you, so the all-time low is in January of 1999. That's because that's when I think the spiders started trading. So you can see, if you take a look at what this did this year, not only is it underperforming, and that we know, but here at the current level, this basically means that the price of the XLE is trading at 19.6% of the price of the spider of SPY. So you have to go all the way back to right about here, March of 2000, the last time this traded in such poor relative terms. So you can look and see that in 2008, energy made its all-time high in relative terms versus the S&P. And barring 2 years since 2008, so only 2 out of the last 11 years, has energy outperformed. It's been the worst sector to be in. 9 of the last 11 years, it's underperformed. And you can see that basically you should have been in any other sector than energy. Virtually in the last 20 years, you would have done better. This has been the absolute worst place. But in an absolute term basis, like I said, now let's just go back to the weekly chart of XLE. We've got some reasons to think that, you can do some bottom fishing. By the way, I'm not terribly friendly to crude over time. I don't think oil has big upside. And those stocks that are very oil sensitive are going to, be kind of hampered, I think, over time, because I don't see a lot of upside potential for oil. But in just looking at energy names in general, I don't mind doing some bottom fishing. Given these downside exhaustion signals that we're seeing, I think some of the names have gotten cheap enough that they're worth taking a look at. Let's move on to financials, XLF. And so this obviously is a sector that everybody wants to see partake and move higher in order for the market to think that you're back in a bull phase. So just a couple things to note. Just about on the all-time highs, 13 signal, upside exhaustion signal early summer, led, before we sold off. And now, again, we're showing potential upside exhaustion. And in fact, right now, let's blow this up a bit. Notice that XLF is trading right on this dotted line. That's the stop out level from this 13. You know, so it's also at a point that there's assumed a fair, higher than normal risk to first buying. So I'd be cautious here about going after this name just blanketly. However, there's some stuff here that's bullish. For instance, the sell-off in May and June bottomed into where you get bearish signals, but they never kicked in. And then over the summer, even though we traded beneath the bearish propulsion level of 26.65, they never broke it the right way. Again, qualified and confirmed. It's a methodology that Tom DeMar came up with to help filter out, to make sure you're not selling here on a break of a support level and then basically selling the low of the move. So it needs to prove itself correctly with a certain set of rules, which in the No Trader clients know as being clients. You know, we talk about them frequently, but not something that we can get to in too much detail here in the weekly podcast. This is now, again, kind of in a place where I'm somewhat concerned. Now, I do think, just again, as a side note, I do think rates bottomed at 1.45% this year. I've been saying so virtually since then. And I do think rates are going to, a good chance rates get above 2% before year's end, and possibly size 2.07. And if that happens, that will be good for the financials. So, you know, part of your willingness to go into the sector or not has to revolve around your thought process on whether or not rates have bottomed or not. And if you think that there's a good chance, you know, we've seen the long-term triple bottom, and that's all it's going to go, or is this a temporary rally in yields, and ultimately the Fed is still going to push yields lower, and you know, we're going to join the rest of the world to get down to near 0%. Right now, that's not my call. I don't see that as of now, and there's no reason to even think that until we take out the triple bottom. So if you take 1.4% on the U.S. 10-year, add or minus 10 basis points to it, that gives you a range of 1.3 to 1.5, and you've got to take that range out before I'd really think that rates could fall underneath 1%. All right, let's keep moving on here. We are now looking at the industrials, XLI. You can see the timeliness, again, of the 13s in the last year. They've all been good. They all sold down to propulsion levels that never got kicked in. We turned around. So this is actually a sector that I think that from the current price of $79.19, we should easily get to 81.45-ish, give or take, if not 82.60-ish, and if not even 83.95. So this actually, I like this price action. Yes, we're still within the context of the 13, but it's not showing up right now. So we did get a sell-off from the prior 13s. This is actually a sector I kind of like right now. XLK, technology. All right, so this is pushing to new highs. You see we gapped higher yesterday, Monday morning. We're actually off a little bit from there. So even though the media would report this being as new all-time highs, note that we're actually lower than where we opened up yesterday. Nonetheless, the price action of down close 3 weeks ago relative to 4 weeks ago, up close last week above our reference line, up close this week, up open this week, that all kind of says that there's a breakout of these 13s, which ups the odds then that this can get to 87.74 as a target. So you probably, I'd say for now, you look for pullbacks to be a buyer. If this gave you a chance to be a buyer near 79.5, I'd probably do it with a fairly tight stop. But this is one of the better ones. XLP, consumer staples, 13 that kind of exhausted us. We've been going sideways. In another few weeks, we potentially get another 13. Let's look at this relative to where all-time highs are, and you see we are on all-time highs. So next upside targets get you anywhere from 62.68 to 62.99. Above there, all the way up at 66 and change on the downside. As long as we stay above 59 and a quarter, this is okay. Breaking underneath 59 and a quarter opens the door, especially if it doesn't in a qualified and confirmed way, opens the door for a move down to 56. Let's see. XLRE would come next, alphabetical. So here's REITs, one of the best sectors this year. But you can see for the last couple months, this has gone nowhere. The good news is even this week bounced off of the latest new bearish propulsion level, as it did over a fair amount of the summer. So this keeps rejecting the downside. It's just not getting a huge breakout to the upside. So right now it's kind of in no man's land. And I would say in between 39.10 and 40.42, there isn't much you can do. If you break through 40.42 on multiple Friday closes, then look for another 5% higher or so up to 42 and change on the downside. If this Friday closes above last Friday's close of 39.49 and then next week closes underneath 39.10, then you have a better chance of this going down. What do we get next? XLU, utilities. So utilities have had a pretty strong year. They are clearly on all-time highs, but now we're getting some stall. And key level is 62.65. Last week was an up close, so if this Friday we close, we sell off another $0.75. So by this Friday we close under 62.65, gap lower next Monday morning, then it's probably indication of further down move. Notice here also one of the few that's getting a MACD sell signal. So utilities are very questionable right here. XLV, healthcare, the second worst performer this year. So you're near all-time highs, which were made in November of last year. Notice that they were made perfectly on a 13 count. This has basically gone nowhere. So this is not a bad chart. It's just that the S&P is up a chunk this year, and this is basically sideways. Now, it is up because if you look at where we started January, which was closer to, I don't know, we're 87-ish, and now we're 94-ish. It's definitely up this year. It's just been a decent underperformer. Look for some resistance between 98.42 and about 100.30 or so. Also, multiple times this year, it broke underneath propulsion sell signals or bearish levels that never kicked in with actual signals. So healthcare, I think, takes out the all-time high, and this has some room to go. So this is actually one of the sectors I like. You've got a positive MACD cross too from something that's gone sideways for a while that looks like it's building up some strength. So that's a good thing. And then our last one is XLY, consumer discretionary names, which have stalled basically from the 13s that we saw in July and September. We've had minor pullbacks. This is just kind of hanging here and hasn't really been able to progress. Looks like the all-time high is 124.60. We actually sold it right near there. We were long at 113 for Inno. So we bought this. No, actually, we bought it in here. We kicked it out here, and we've been flat as a sector since. So not much to do right here. I'd say I'm kind of neutral there. And that does it. That's our 30 minutes together for this week's show. And hopefully you got some good information about how to play the S&P. I'm Rick Bensignor, and thanks for listening to In the Know Trader.